Welcome to The Pitch, brought to you by Livewire Markets. I'm Huntsley, and joining me today, Nick Raphaely of AltX. Our discussion today will revolve around what some are calling the hottest trade on the street, private credit. So, Nick, in plain English, first up, what does private credit mean to you as an investor?
So, Hans, we like to describe it very simply as you can be the bank. What that means is, if you think about it, when a bank lends money to a borrower, they do a valuation, they write loan documents, they register a mortgage, the borrower pays monthly interest and capital back at the end. All comes to the bank. When you do it as a private investor, it's exactly the same, except the investor puts up the capital, the investor gets the benefit of the valuation, the benefit of the loan documents, receives the interest and the capital back at the end. The investor literally gets to be in the position of the bank. So very, very simple. The bank model has been successful for banks for so long. Our proposition to investors is you get to enjoy the riches that the banks for so long have enjoyed.
So if I take a look then at this particular asset class, what would you say is your risk-reward profile, if you like? Or how much risk do you need to take on versus what kinds of returns that investors can expect?
So the rates have moved over time. Obviously, we're in a higher rate environment than we were previously. In the current environment with our set of products, investors can be earning a net return of anywhere between, I would say, low 8% on the low end, all the way up to 11 or 12%. So in sort of that 8 to 11% range. And for that, they're getting a transaction which is secured by a mortgage, a first mortgage, over a property which they can read the valuation of, they can visit the property, they can assess, they get the benefit of the loan docs, they get guarantees from the sponsors. So in a downside scenario, they are protected by hard assets and they're earning a high single digit, low double digit return. So we think it's very, very compelling in any environment, but particularly in this environment because elevated rates have improved the rates to investors.
Yeah, I was about to say then, what is how much risk is the individual investor taking on?
Well, the way we like to say it is because the loan is backed by a hard asset in the form of a building, a house, a commercial property, an industrial property, or some land. In a worst case scenario, as the investor in the deals, the lender to the borrower, the asset can be sold and the capital can be repaid to the investor that way. So if everything else goes bad, the borrower disappears, doesn't repay, et cetera, you can foreclose on the property, sell the property and return the capital. So obviously absent things like fraud and gross negligence and mismanagement, we think that the prospect of an investor suffering a material loss is very, very low. Compare that to the equity markets, for example, where anything can happen to equities on any given day. In the example of secured asset lending, you've got this buffer between the amount you lend and the amount that the asset is worth. So that provides an inherent built-in buffer for investors.
Where do you find your most profitable opportunities right now?
I think construction funding, as I touched on in a previous discussion, I think construction funding provides a really good opportunity simply because it requires an experienced team to execute. And so the barriers to entry as a lender are higher, which means less competition, which means you can charge borrowers more. And it means borrowers will come to you if they see value in your expertise. So you attract the best deals, and therefore you can pass on those opportunities to your investor clients. And we've been in the construction space since 2017, so a 7-year track record. We funded many hundreds of millions of dollars worth of deals. And so that allows us to attract what we think are really good opportunities. Like sometimes you see like fantastic deals. Like we're doing a deal in Palm Beach at the moment. So a borrower's got a virtually completed home. The broad metrics are properties worth $12 or $13 million. They want a loan for $5 or $6 million. They've substantially done all the work themselves. They just need money to finish off the construction. So we can send our team in, they can look at the deal, we can get comfortable that they've done a good job on building so far, so they'll be able to get all the certificates to get the occupation certificate, and therefore we can provide that funding. So what does that mean to an investor? You get to put $5 million into an asset which is worth 12 or 13, which the borrower is going to sell once they've finished completion. Very, very difficult not to get a good outcome as an investor in a deal like that. So people bring those deals to us because they know we do construction well. And I think being able to offer that as part of our suite really, really helps the business and attracts good opportunities, which we can then pass on to our investors.
Perfect. Nick Raphaely, thank you very much for joining us. And thank you for joining us for The Pitch. If you enjoyed that video, you can subscribe to the Livewire Market Index websites as well as our YouTube channel. We'll see you next time.